Hello and welcome. Over the next 10 minutes, we're going to start a journey together into a topic you've probably heard about but might find a little confusing: cryptocurrency. Maybe you've seen it in the news, heard friends talking about Bitcoin, or seen stories online of people making and losing a lot of money. It can all seem very complicated and maybe even a little intimidating. The goal of this first chapter is to cut through the noise and answer a very simple question. What is cryptocurrency? We're going to break it down in a way that anyone can understand, using simple examples you can relate to. Before we dive in,
the information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
So let's start with the basics. The word cryptocurrency itself gives us a couple of clues. It's a combination of cryptography and currency. Let's first think about currency. You already know what that is. The US dollar in your bank account or the cash in your wallet is currency. It's a system of money we use to buy things, from a cup of coffee to a new car. It's issued and controlled by a central authority, which in the United States is the government and the Federal Reserve. They print the money, they set the rules, and they have the final say. Now let's think about that first part of the word, cryptography. This might sound like something out of a spy movie, but it's a technology you use every single day. Cryptography is the science of securing communication. When you shop online and enter your credit card number, or when you log into your email, cryptography is working in the background to scramble that information, so that only the intended recipient can unscramble and read it. It's a way of making digital information secure and private. So when you put those two ideas together, you get cryptocurrency. It is a form of digital or virtual money that is secured using cryptography. But here is the most important difference, and it's the idea that changes everything. Unlike the US dollar, most cryptocurrencies are not controlled by any single company, government, or bank. This is what people mean when they say cryptocurrency is decentralized. Imagine you and a group of friends decide to create your own digital token to trade things among yourselves. Instead of having one person in charge of keeping a notebook of who has what, everyone in the group gets a copy of the notebook. Every time one of you gives a token to another, you all update your notebooks together. Because everyone has a copy of the notebook and you all agree on the updates, it would be very difficult for one person to cheat the system. Someone couldn't just add extra tokens for themselves in their own notebook, because it wouldn't match what everyone else in the group has. In a nutshell, that's the big idea behind most cryptocurrencies. The notebook, in our example, is called a distributed ledger, and the most common form of it is a technology called the blockchain. You've probably heard of blockchain, and it's a key part of understanding cryptocurrency. Let's break down the word blockchain. It's a chain of blocks. Think of it like a digital receipt book. Each block is a page in the receipt book, and it's filled with a list of recent transactions. Once a page is full of transactions, it gets added to the book, and a new page is started. But here's the clever part. Each new page or block is cryptographically linked to the page before it. It creates a chain. This chain of blocks is the blockchain. This chain has a few special properties. First, once a block of transactions is added to the chain, it's incredibly difficult to change. To go back and alter an old transaction would mean you'd have to change every single block that came after it, which requires an immense amount of computing power. This makes the blockchain very secure and permanent. It's what people mean when they say the ledger is immutable. Second, as we mentioned in our friends and notebooks example, this digital receipt book isn't kept in one single place. It's copied and spread across a vast network of computers all over the world. Anyone participating in the network has a copy of the blockchain. This decentralization means that no single person or group can control it. A bank can freeze your account, or a government can decide to print more money. With a decentralized cryptocurrency, those things aren't possible in the same way because the control is distributed among the users of the network. So when someone sends a cryptocurrency like Bitcoin to another person, that transaction is broadcast to the network. A group of participants in the network, often called miners or validators, work to confirm that the transaction is legitimate. They bundle it together with other recent transactions into a new block, solve a complex mathematical puzzle to secure it, and then add that new block to the blockchain. Once the block is added, the transaction is confirmed and complete, and everyone's copy of the digital receipt book gets updated. Let's recap what we've covered so far. Cryptocurrency is a type of digital money. It's secured with cryptography, and most cryptocurrencies run on a technology called blockchain, which is like a shared, super secure, public receipt book that isn't controlled by any one central authority. This idea of decentralization is the foundation of almost everything in the world of crypto. You might be wondering, why do we need this? It's a great question. The traditional financial system, with its banks and government oversight, works well for many people. But proponents of cryptocurrency point to a few potential benefits of a decentralized system. For example, because there are no intermediaries like banks, transactions can sometimes be faster and cheaper, especially for sending money across borders. It also offers a way for people who may not have access to traditional banking services to participate in a global financial system. And for some, there is a philosophical appeal to a form of money that is not subject to the control or potential inflation policies of a single government. The very first and most famous cryptocurrency is Bitcoin, which was created in 2009 by a mysterious person or group of people known only as Satoshi Nakamoto. Bitcoin was the first to successfully use blockchain technology to create a secure, decentralized digital currency. Since Bitcoin, thousands of other cryptocurrencies have been created. You may have heard of some of them, like Ethereum, which is known for its ability to run smart contracts, which are like automated agreements that live on the blockchain. We will explore these different types of cryptocurrencies in later chapters. For now, it's important to remember that this is all still very new technology. The world is still figuring out what cryptocurrencies are best for, how they should be regulated, and what their true value is. This leads to a lot of price volatility, meaning the value of cryptocurrencies can go up or down very quickly. It's a landscape that is constantly evolving, and that's why a foundational understanding is so important. So to bring it all together for our first chapter, think of cryptocurrency as a new form of money for the internet. It's digital, it's secured by code, and its transactions are recorded on a public ledger called a blockchain. Its key feature is that it's decentralized, meaning it's a community effort, not a corporate or government one. We've laid the groundwork today. We've defined the key terms and explained the core concepts in a simple way, without all the confusing jargon. We've also made it clear that this is a complex and evolving space. In our next chapter, we'll take a closer look at the technology that makes it all possible. The blockchain. We'll explore in more detail how it works and why it's considered so revolutionary, not just for money, but for many other industries as well. Thank you for listening. Hello and welcome back. In our last chapter, we introduced the basic idea of cryptocurrency as a form of digital money secured by cryptography. We briefly touched upon its decentralized nature and mentioned the core technology that makes it all possible, the blockchain. Today, we're going to dive deeper into that engine. Our goal is to understand what a blockchain really is, how it works, and why so many people believe it's a revolutionary technology, not just for currency, but for many other areas of our digital lives. Just like last time, a quick and important reminder. This content is for educational and informational purposes only. We are not providing any financial, investment, tax, or legal advice. The world of digital assets is complex, and you should always conduct your own thorough research and consider speaking with qualified professionals to help with any financial decisions. So let's get started. In our last chapter, we used the analogy of a shared digital notebook or a receipt book. Let's expand on that. Imagine a special kind of notebook that is designed for ultimate trust and security. First, this notebook isn't made of paper, its pages are digital. We call these digital pages blocks. Each block is like a page in a ledger where we record a list of transactions. For example, a block on the Bitcoin blockchain might contain a record saying, Alice sent 1 Bitcoin to Bob, Charles sent 2 Bitcoins to David, and so on. A single block can hold thousands of these transaction records. Now, once a page or a block is filled with transactions, it needs to be sealed and added to the notebook. This is where the magic of cryptography comes in. To seal the block, a unique, complex mathematical puzzle is solved by computers on the network. When the puzzle is solved, it creates a unique digital fingerprint for that block, something called a hash. This hash acts as a seal. It guarantees that the information inside the block is secure. If even a single comma or a number in the transaction list were changed, the digital fingerprint, the hash, would change completely. This makes it instantly obvious if someone has tried to tamper with the records. This is where the chain part of blockchain comes into play. Each new block that is created doesn't just have its own unique fingerprint, or hash. It also contains the hash of the block that came immediately before it. Think of it like this. Imagine each page of our notebook has a unique serial number printed at the bottom. But to make it even more secure, page 2 not only has its own serial number, but it also has page 1's serial number printed at the top. Page 3 has its own serial number plus page 2's serial number. This creates a link, or a chain, connecting every page to the one before it, all the way back to the very first one. This chaining is what makes a blockchain so incredibly secure. If a hacker wanted to go back and change a transaction on, say, page 50 of our notebook, they would first have to break the seal, the hash, on that block. If they managed to do that and change the record, the hash of block 50 would change. But remember, block 51 contains the original hash of block 50. So now the hacker's altered block 50 no longer matches the link recorded in block 51. The chain is broken. To cover their tracks, the hacker would then have to change block 51, which would change its hash, which would mean they'd have to change block 52. And so on, all the way to the end of the chain. It's like trying to secretly change a single link in a metal chain. You can't do it without leaving obvious signs of damage on all the connecting links. This structure makes the history of transactions on a blockchain effectively immutable or unchangeable. But there's another layer of security, and it relates back to that key concept we discussed in Chapter 1. Decentralization. Who holds this special notebook? The answer is, not just one person. A copy of the entire blockchain is held by thousands of people, or nodes, on a global network of computers. When a new block of transactions is ready to be added to the chain, it's broadcast to everyone on the network. The computers on the network all work to verify the transactions and solve the mathematical puzzle to seal the block. Once the puzzle is solved, the new block is added to the end of the chain, and everyone updates their copy of the notebook. This distributed nature is a powerful security feature. For a hacker to successfully alter the blockchain, they wouldn't just need to rewrite all the blocks on one person's copy of the notebook. They would have to simultaneously hack into and change the notebook on thousands of computers, at least 51% of them, all at the same time. The sheer scale and computing power required to do this for a large, established blockchain like Bitcoin's is considered practically impossible. This is what we mean by a distributed, trustless system. You don't have to trust any single person or company because the trust is built into the system itself, verified by the entire community. Let's compare this to a traditional system like a bank. When you send money, your bank updates its private ledger, which is stored on its own central servers. You trust the bank to keep accurate records and to protect those records from hackers. In the blockchain model, the ledger is public, and the security comes from the fact that it is massively distributed and constantly being verified by the entire network. There is no single point of failure. If one computer on the network goes down, it doesn't matter. The blockchain continues to run on the thousands of other computers. So, let's quickly review the three key pillars of blockchain technology: blocks and hashes. Transactions are recorded in blocks, and each block is sealed with a unique cryptographic fingerprint called a hash. The chain. Each new block is linked to the one before it, creating a secure and unbreakable chain of records. Decentralization. The ledger is copied and spread across a vast network of computers, making it transparent and incredibly difficult to tamper with. Understanding these pillars helps us see why blockchain is more than just a database. It's a new way of recording and verifying information in a secure, transparent, and permanent way, without needing a central authority to be in charge. While Bitcoin was the first major application of blockchain, this technology has potential uses far beyond digital currency. Think about any situation where trust, transparency, and permanent records are important. For instance, it could be used to create tamper-proof voting records, or to track goods in a supply chain, so you could scan a bag of coffee in the supermarket and see exactly which farm it came from and every stop it made along the way. It could be used for managing medical records, ensuring that a patient's data is secure and cannot be altered without their permission. These are just a few of the possibilities that people are exploring. It's important to note that, like any new technology, blockchain has its challenges. Some blockchains can be slow and consume a lot of energy. And because the technology is still evolving, its application in these other fields is still largely experimental. To wrap up today's chapter, the main takeaway is that the blockchain is the foundational technology that allows cryptocurrencies to exist. It is a shared, secure, and permanent digital ledger that is maintained by a global community instead of a single company or government. Its innovative structure, combining cryptographic seals with a distributed network, creates a powerful new system for recording information with an unprecedented level of trust. We've now covered the what of cryptocurrency and the how of the blockchain. In our next chapter, we'll start to look at the who by exploring the different types of cryptocurrencies out there, starting with the one that began it all, Bitcoin. We'll discuss its history, its purpose, and what makes it unique in the vast crypto landscape. Thank you for listening. Hello and welcome back. In our first two chapters, we explored the what of cryptocurrency and the how of the blockchain technology that powers it. Today we're going to focus on the one that started it all, Bitcoin. Even if you know very little about crypto, chances are you've heard its name. Bitcoin is not just a cryptocurrency, it's the original proof of concept that showed the world a decentralized digital currency was possible. Our goal today is to understand its origin story, its core features, and the problem it was designed to solve. As always, we must begin with our important disclaimer. This chapter and our series are for informational and educational purposes only. The content is not financial, investment, legal, or tax advice. The world of cryptocurrency is volatile and carries risks. Always conduct your own detailed research and consider consulting with qualified professionals before making any financial decisions. The story of Bitcoin begins in late 2008, a time of significant global financial turmoil. The traditional banking system was facing a severe crisis, and public trust in financial institutions was shaken. It was in this environment that a paper was published online to a small mailing list of cryptographers. It was titled, Bitcoin, a peer-to-peer electronic cash system. The author of this paper was a person, or perhaps a group of people, using the pseudonym Satoshi Nakamoto. To this day, the true identity of Satoshi Nakamoto remains one of the biggest mysteries of the digital age. Satoshi's 9-page white paper laid out the blueprint for a new kind of money. The goal was to create a form of digital cash that could be sent directly from one person to another without going through a financial institution like a bank or a payment processor. It was a direct response to the reliance on trust that our traditional financial system is built upon. In a world of banks, we trust them to manage our money, process our transactions, and not make irresponsible decisions. Satoshi proposed a system where trust was replaced by cryptographic proof. The blockchain, which we discussed in our last chapter, was the mechanism to achieve this. On January 3, 2009, the Bitcoin network officially came into existence when Satoshi Nakamoto mined the very first block on the blockchain, known as the Genesis block. Embedded within this block was a headline from that day's edition of the Times of London. Chancellor on brink of second bailout for banks. Many interpret this as a direct commentary on the financial instability that Bitcoin was created to address, a timestamp and a mission statement all in one. So what makes Bitcoin unique? Let's explore two of its most important characteristics: its limited supply and the process of how new coins are created. First, let's talk about digital scarcity. In the physical world, things can be scarce. There is only a finite amount of gold on Earth, for example. This scarcity is one of the reasons it has been used as a store of value for thousands of years. But in the digital world, things are usually infinitely reproducible. You can copy and paste a text document or an image a million times, and each copy is a perfect duplicate. This is known as the double spending problem. Before Bitcoin, if you had a digital dollar, it was difficult to prevent you from spending that same digital dollar in multiple places. Banks solved this by keeping a central ledger. Bitcoin solved it with the blockchain, ensuring that once a coin is spent, that transaction is recorded and verified by the network, and the coin cannot be spent again. Satoshi took this a step further. The rules of the Bitcoin system, written into its core code, dictate that there will only ever be 21 million Bitcoins created, not 21,000,001. This number is finite and unchangeable. This makes Bitcoin a deflationary asset by design, much like a precious metal. Unlike traditional currencies, where a central bank can decide to print more money, potentially leading to inflation and devaluing the currency already in circulation, the supply of Bitcoin is fixed and predictable. This leads to our second key feature. How are new Bitcoins created and introduced into the system? This happens through a process called mining. In the last chapter, we talked about how a network of computers around the world works to validate transactions and seal them into blocks. This work requires a massive amount of computational power. To encourage people to contribute this computing power to secure the network, the Bitcoin protocol rewards them. Think of it like a global competition that happens about every 10 minutes. The computers on the network, known as miners, are all racing to solve that complex mathematical puzzle we mentioned. The first miner to find the solution gets to add the next block of transactions to the blockchain. As a reward for their effort, for using their electricity and computing hardware, they are awarded a certain amount of brand new Bitcoin that was just created. This reward is how new coins enter circulation. This process serves two critical purposes at once. It's the system for creating new coins, and it's also the mechanism that secures the network and validates transactions. The miners are essentially the auditors of the Bitcoin ledger. An interesting feature of this system is something called the halving. The Bitcoin code dictates that roughly every 4 years, the reward that miners receive for adding a new block is cut in half. When Bitcoin first started, the reward was 50 Bitcoins per block. Around 2012, it was halved to 25. In 2016, it was halved again to 12.5, and so on. This process will continue until the last fraction of a Bitcoin is mined, which is estimated to happen around the year 2140. This gradual reduction in the creation of new coins ensures that the supply is released at a predictable, slowing rate, reinforcing its scarcity over time. So, to recap, Bitcoin was introduced to the world as a solution to the need for a trusted third party in online payments. It uses a decentralized blockchain to allow for peer-to-peer transactions. Its two defining features are its fixed, finite supply of 21 million coins, which creates digital scarcity, and its mining process, which both secures the network and manages the creation of new coins in a predictable way. In its early days, Bitcoin was a niche interest for a small community of cryptographers and computer enthusiasts. Today, it has become a global phenomenon. But it's important to remember what it was originally designed to be, an electronic cash system. In the next chapter, we'll explore some of the other major cryptocurrencies that came after Bitcoin, often referred to as altcoins, and discuss how they sought to improve upon or offer different features than the original. Thank you for listening. Hello and welcome back to our series. In the last chapter, we took a close look at Bitcoin, the original cryptocurrency that started it all. For many years, Bitcoin was essentially the entire crypto world. But today there are thousands of different digital assets. Anything that isn't Bitcoin is generally referred to by a simple catch-all term, an altcoin, which is short for alternative coin. Today, our goal is to explore this vast world beyond Bitcoin. We will look at why altcoins were created and introduce a few key examples to understand the different goals and technologies they bring to the table. As we begin, it is essential to reiterate our standard disclaimer. This content is created for informational and educational purposes only. We are not providing financial, investment, tax, or legal advice. The cryptocurrency market is known for its volatility, and every digital asset has its own unique characteristics and risks. Please always conduct your own thorough research and consider consulting with qualified professionals regarding any financial decisions. So why do altcoins even exist? If Bitcoin created a secure, decentralized digital currency, why was there a need for anything else? The answer lies in innovation and specialization. While Bitcoin was a revolutionary invention, some developers and entrepreneurs saw areas where they believed it could be improved or adapted for different purposes. Some wanted to create cryptocurrencies that were faster or had lower transaction fees. Others had entirely new visions for what a blockchain could do, far beyond just being a system for digital cash. This led to a wave of new projects, each with its own unique approach. Let's start with one of the earliest and most well-known altcoins, Litecoin. Created in 2011 by a former Google engineer named Charlie Lee, Litecoin was designed with a goal that's easy to understand. Lee described Litecoin's relationship to Bitcoin as being like silver to Bitcoin's gold. It wasn't meant to replace Bitcoin but rather to complement it. The technical differences are straightforward. While a new block of transactions is added to the Bitcoin blockchain roughly every 10 minutes, the Litecoin network does the same thing in just 2.5 minutes. This faster block time means that transactions can be confirmed more quickly. From a user's perspective, this could be seen as an advantage for everyday purchases, where you wouldn't want to wait 10 minutes for a payment to clear. Additionally, Litecoin has a larger total supply, 84 million coins compared to Bitcoin's 21 million. These changes were not a reinvention of the wheel, but rather a tweak to the original Bitcoin code, aimed at creating a lighter, faster version for more frequent, smaller transactions. While projects like Litecoin aim to be a better form of digital cash, the next major innovation in the altcoin space introduced a radically different idea. This was Ethereum. Launched in 2015, Ethereum's creators envisioned a blockchain that could do more than just track transactions. They wanted to build a decentralized world computer. The key innovation that Ethereum brought to the world was the concept of smart contracts. In our last chapter, we talked about how a blockchain is a secure and reliable ledger. A smart contract takes that one step further. It's a computer program that runs on the blockchain. These programs can automatically execute the terms of an agreement when certain conditions are met. Think of it like a highly trustworthy vending machine. In a normal vending machine, you put in your money, the condition, and the machine automatically dispenses your snack, the execution of the agreement. There's no need for a cashier. A smart contract does something similar, but with digital assets and complex agreements. For example, a smart contract could be written to automatically release a payment to a musician every time their song is streamed. Or it could be used to create a digital identity system, or even manage the ownership of a physical asset like a house. This capability to run code on the blockchain opened up a whole new world of possibilities. It allowed developers to build decentralized applications, or dApps, that run on the Ethereum network. These are like the apps on your smartphone, but instead of running on servers owned by Google or Apple, they run on a distributed network of computers, free from the control of any single company. This has led to the development of new fields like decentralized finance, or DeFi, which aims to recreate traditional financial services like lending and borrowing using smart contracts on the blockchain. The currency of the Ethereum network, called Ether or ETH, is used to pay for the computational power required to run these smart contracts and dApps. Finally, let's look at another type of altcoin that was designed to solve a very different problem: XRP. The technology behind XRP was created with the traditional financial world in mind, specifically the challenge of cross-border payments. When you send money from the United States to another country, it often has to go through multiple banks in a slow and expensive process called the correspondent banking system. The creators of the XRP ledger, the blockchain on which XRP exists, aim to make these international transactions faster and cheaper. XRP was designed to act as a bridge currency. A financial institution in one country could convert its local currency into XRP, send the XRP across the network in a matter of seconds, and another institution in the destination country could convert that XRP back into its own local currency. This process could potentially bypass the complex web of intermediary banks, settling international payments almost instantly and at a very low cost. The company most closely associated with this technology is Ripple, which works with financial institutions to promote the use of this system. These three examples, Litecoin, Ethereum, and XRP, give us a small glimpse into the diversity of the altcoin world. Litecoin aimed to be a faster, cheaper version of Bitcoin for payments. Ethereum introduced the idea of a programmable blockchain with smart contracts, creating a platform for decentralized applications. And the XRP ledger was designed as a specialized tool to improve international finance. There are thousands of other altcoins, each with its own specific goals, from focusing on user privacy to building social media platforms or managing supply chains. It's important to understand that not all of these projects will succeed, and the space is filled with experimentation. However, their existence shows how the original idea of Bitcoin has inspired a massive wave of innovation, as developers around the world explore the many potential uses of blockchain technology. To conclude, altcoin is simply a term for any cryptocurrency that is not Bitcoin. They were created to improve upon Bitcoin's design, or to use blockchain technology for entirely new purposes. By looking at examples like Litecoin, Ethereum, and XRP, we can see that this is not a one-size-fits-all world. It's a diverse ecosystem of different technologies, each trying to solve a different problem. In our next chapter, we'll shift our focus to a critical aspect of using cryptocurrency: how to acquire and store it safely. Thank you for listening. Hello and welcome back. Over the last 4 chapters, we've built a solid foundation, understanding what cryptocurrency is, how blockchain works, and the differences between major projects like Bitcoin and various altcoins. Now we're going to move from the theoretical to the practical. Today's chapter will address 2 of the most common questions from beginners. How does a person actually get cryptocurrency? And once they have it, where do they keep it? We'll discuss the general process of acquiring digital assets, and explore the crucial topic of digital wallets and security. Before we dive in, we must reinforce our most important message. This chapter is for informational and educational purposes only. It is not an endorsement of any platform or product and should not be considered financial, investment, or security advice. The process of acquiring and storing cryptocurrency involves significant personal responsibility and risk. Always exercise extreme caution. Do your own extensive research, and consider seeking guidance from qualified professionals. Let's start with the first question. How do you acquire cryptocurrency? For most people in the United States,
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The most common on-ramp is a centralized cryptocurrency exchange. Think of an exchange as a digital marketplace where you can buy, sell, and trade different cryptocurrencies using US dollars. These are for-profit companies that act as an intermediary, much like a stock brokerage does for stocks. To use one of these exchanges, you typically need to go through a straightforward process. First, you create an account. Because these companies operate in the United States, they are required to follow financial regulations. This means you will almost certainly need to complete a process called Know Your Customer, or KYC. This involves providing personal information, such as your legal name, address, and social security number, and often requires you to upload a photo of a government-issued ID, like a driver's license. This process is in place to prevent fraud and other illicit activities. Once your identity is verified, the next step is to fund your account. You can usually link a bank account to transfer funds via an ACH transfer or a wire transfer. Some platforms may also allow you to use a debit card. After your account is funded with US dollars, you can then use those funds to buy cryptocurrencies available on the platform, whether it's Bitcoin, Ethereum, or another altcoin. The process is typically as simple as selecting the asset you want, entering the dollar amount you wish to spend, and confirming the purchase. While exchanges make it easy to buy and sell, this brings us to the most critical topic of this chapter: storage. When you buy cryptocurrency on a centralized exchange, the company holds it for you in an account under your name. This is very convenient, but it comes with a fundamental trade-off. You are trusting that company to keep your assets safe. This leads us to the world of crypto wallets. A crypto wallet is a tool that allows you to interact with your cryptocurrency, but it's important to understand what a wallet actually stores. Your coins are not literally inside the wallet like cash in a leather billfold. Your coins always exist on the blockchain. What your wallet stores are your keys. There are two types of keys: a public key and a private key. Your public key is like your bank account number. You can share it with others without worry. If someone wants to send you cryptocurrency, you give them an address derived from your public key. Your private key, on the other hand, is like your bank account password or the PIN for your ATM card. It is a secret code that proves you are the owner of the cryptocurrency associated with your public key. Your private key is what you use to sign, or authorize, transactions to send your crypto to someone else. It is the single most important piece of information you need to protect. Anyone who has your private key has complete control of your funds. You should never, ever share it with anyone for any reason. This brings us to a crucial distinction between types of wallets. First, there are custodial wallets. When you leave your crypto on a centralized exchange, you are using a custodial wallet. The exchange takes custody of your private keys on your behalf. The benefit is convenience. You can log in with a simple username and password, and if you forget your password, you can reset it. The downside is that you are not truly in control. You are trusting the exchange's security. This leads to a popular saying in the crypto community: not your keys, not your coins. Second, there are non-custodial wallets. With these wallets, you and only you hold the private keys. This gives you full control and sovereignty over your assets. However, it also means you bear 100% of the responsibility for securing them. If you lose your private keys, there is no customer service line to call. There is no password reset. Your funds are likely gone forever. Non-custodial wallets themselves come in two main forms: software wallets, hot wallets. These are applications you can install on your computer or smartphone. They are called hot wallets because they are connected to the internet. This makes them very convenient for sending, receiving, and using your crypto frequently. However, because they are on a device that is connected to the internet, they have a larger potential attack surface for hackers, viruses, and malware. Hardware wallets, cold wallets. These are small, physical devices, often resembling a USB stick, that are specifically designed to store your private keys offline. This is why they are called cold storage. When you want to make a transaction, you plug the device into your computer. The transaction is signed inside the secure chip on the device itself, so your private key is never exposed to the internet-connected computer. For this reason, Hardware wallets are widely considered to be one of the most secure methods for storing a significant amount of cryptocurrency. When you set up a non-custodial wallet, you will almost always be given a seed phrase or recovery phrase. This is typically a list of 12 to 24 random words. This phrase is a master key that can be used to restore your wallet and access your funds if your device is lost, stolen, or broken. Protecting this seed phrase is just as important as protecting your private keys. You should write it down on paper and store it in a secure, private, physical location, or multiple locations, where no one else can find it. Never store it as a digital file on your computer or phone, and never take a picture of it. To summarize, getting started typically involves using a centralized exchange to convert dollars into crypto. But for long-term storage and security, understanding wallets is essential. A custodial wallet on an exchange offers convenience at the cost of control. A non-custodial wallet gives you full control, but demands full responsibility. Within non-custodial options, software wallets are convenient for everyday use, while hardware wallets offer a higher level of security for safekeeping. In our next chapter, we will delve into the practical side of the crypto world by exploring some of the common uses and applications for cryptocurrency beyond just buying and holding it as an asset. Thank you for listening. Hello and welcome back. So far in our series, we've covered the what, how, and why of cryptocurrency, from the basics of blockchain to the different types of digital assets and how to securely store them. A common perception of cryptocurrency, often seen in news headlines, is that it is primarily a speculative investment, something people buy hoping its value will increase. While that is certainly one aspect of the market, it's far from the whole story. Today, we're going to explore the practical side of crypto and discuss some of its real-world applications and use cases. Our goal is to understand how people are using this technology today, beyond simply buying and holding. As always, we must begin with our critical disclaimer. This content is for educational and informational purposes only. It is not financial advice, an endorsement of any service, or a recommendation to use any specific application. The cryptocurrency space is still new and carries inherent risks. Please conduct your own thorough research and exercise caution when interacting with any digital asset or platform. Let's start with the most straightforward use case, the one Satoshi Nakamoto originally envisioned for Bitcoin: payments. While you may not be buying your morning coffee with Bitcoin just yet, the use of cryptocurrency for transactions is growing. Many online retailers and tech companies now accept direct crypto payments. More practically for everyday use, a number of companies offer crypto debit cards. These cards are linked to a user's cryptocurrency balance. When you swipe the card at a store, the service instantly converts the necessary amount of your crypto into US dollars to complete the purchase, allowing you to spend your digital assets anywhere that accepts traditional debit cards. Another powerful use case, especially on a global scale, is remittances. Sending money to family or friends in another country through traditional means can often be a slow and expensive process, with fees taking a significant percentage of the total amount. Cryptocurrency offers a potential alternative. By using a digital asset, particularly a type of cryptocurrency called a stablecoin, which is designed to maintain a stable value, often pegged to the US dollar, a person can send funds across borders quickly and with very low transaction fees. The recipient can then convert the stablecoin back into their local currency. For many, this represents a more efficient way to send financial support to loved ones around the world. Beyond simple payments, the most dynamic and innovative area of cryptocurrency use is decentralized finance, or DeFi. As we touched on in Chapter 4, DeFi aims to rebuild traditional financial services on the blockchain, primarily on platforms like Ethereum that support smart contracts. Instead of relying on banks or brokerage firms as intermediaries, DeFi applications use code to create a transparent and open financial system. Let's look at a couple of basic examples of what you can do in DeFi. One of the most popular activities is lending and borrowing. DeFi platforms allow users to lend their cryptocurrency out and earn interest on it, much like a savings account at a bank. Other users can then borrow those assets by putting up their own crypto as collateral. All of this is managed automatically by smart contracts, which set the interest rates based on supply and demand and manage the collateral to ensure the loans are secure. The key difference is that there's no bank in the middle taking a cut. It's a peer-to-peer system. Another core component of DeFi is the decentralized exchange, or DX. Unlike the centralized exchanges we discussed in the last chapter, which are run by a single company, a DX allows users to trade cryptocurrencies directly with each other from their own non-custodial wallets. Smart contracts act as the automated market makers, facilitating the trades without the need for a central order book or intermediary. The world of DeFi is vast and complex, with many other applications, but the core idea is to create a financial system that is more open, transparent, and accessible to anyone with an internet connection, removing the traditional gatekeepers. Finally, we can't talk about crypto use cases without mentioning non-fungible tokens, or NFTs. This is a term you have almost certainly heard. Let's break down what it means. Most currencies are fungible. A $1 bill is fungible because it's interchangeable with any other $1 bill. They have the same value and are not unique. A non-fungible item, on the other hand, is one of a kind. A famous painting like the Mona Lisa is non-fungible. You can't just swap it for another one. An NFT is a unique digital token on a blockchain that represents ownership of a specific asset. While NFTs became famous for representing digital art and collectibles, the underlying technology has much broader applications. An NFT could be used to represent the deed to a house, a ticket to a concert, an in-game item in a video game, or even a college diploma, because the ownership is recorded on a secure and transparent blockchain. It provides a verifiable and tamper-proof way to prove who owns a specific digital or even physical item. The potential here is to create a universal and secure system for tracking ownership of unique assets. To bring it all together, the use cases for cryptocurrency and blockchain technology have expanded far beyond the original idea of a simple digital cash system. People are using it for everyday payments through crypto debit cards, for more efficient international remittances, and to participate in a new, open financial system called DeFi. And with NFTs, the technology is being used to create new ways to verify ownership of unique digital and real-world items. These applications are still in their early stages of development and adoption, and there are many challenges and risks involved. However, they demonstrate that the core technology of a secure, decentralized ledger has the potential to be used in many different and innovative ways. In our next chapter, we'll discuss the important topic of the regulatory landscape and how governments, particularly in the United States, are approaching this new technology. Thank you for listening. Hello and welcome back to our educational series. We've journeyed through what cryptocurrency is, how it works, and its various applications. Now we must turn to a topic that is critically important for anyone interested in this space: regulation. How does the United States government view and regulate digital assets? The answer isn't simple. There isn't one single law or one agency in charge. Instead, it's a complex and evolving landscape. Our goal today is to provide a clear, high-level overview of this regulatory environment, helping you understand the key players and their roles. Before we proceed, it is absolutely essential to state that this chapter is for informational purposes only and is not legal, tax, or financial advice. The regulatory and tax rules surrounding cryptocurrency are complex and can change. You should always consult with qualified legal and tax professionals for advice tailored to your specific situation. In the US, the approach to regulating crypto is often described as a patchwork quilt, with several different government agencies overseeing different aspects of the market based on existing financial laws. Let's talk about the main agencies involved. First, there is the Securities and Exchange Commission, or the SEC. The SEC's primary mission is to protect investors and maintain fair and orderly markets. The big question the SEC grapples with is whether a specific cryptocurrency should be classified as a security. A security is a tradable financial instrument, like a stock or a bond. To determine this, the SEC often uses a legal framework called the Howey test, which comes from a 1946 Supreme Court case. In simple terms, the test asks if people are investing money in a common enterprise with the expectation of profit from the efforts of others. Based on this test, the SEC has stated that while it may view a decentralized asset like Bitcoin as a commodity, it considers many other digital tokens, especially those sold to the public through initial coin offerings or ICOs, to raise money for a project, to be securities. If a crypto asset is deemed a security, it falls under strict SEC rules regarding registration and disclosure, all designed to protect the investing public from fraud and misinformation. Next, we have the Commodity Futures Trading Commission, or the CFTC. The CFTC is responsible for regulating commodity markets, which include things like oil, wheat, and gold. The CFTC has officially classified Bitcoin and Ethereum as commodities. As a result, the CFTC oversees the derivatives markets for these assets, such as futures and options contracts that are traded on regulated exchanges. The agency's role here is to prevent fraud and manipulation in these markets. This has created a long-running debate in Washington about which agency should have primary authority over the crypto spot markets, the SEC or the CFTC. Then there is the Department of the Treasury, which has two important bureaus. The first is the Financial Crimes Enforcement Network, or FinCEN. FinCEN's job is to combat financial crimes like money laundering and terrorist financing. FinCEN doesn't focus on whether crypto is a security or a commodity. It views it as a form of value that can be transmitted. Therefore, it requires cryptocurrency exchanges and other money service businesses to comply with the Bank Secrecy Act. This is why, as we discussed in Chapter 5, you must provide personal information and verify your identity to use a US-based exchange. These Know Your Customer, or KYC rules, are a core part of FinCEN's oversight. The second key bureau within the Treasury is the Internal Revenue Service, or the IRS. This is an area that directly affects any user who buys, sells, or trades cryptocurrency in the US. For federal tax purposes, the IRS does not treat cryptocurrency as currency like the US dollar. Instead, it treats it as property. This classification has significant tax implications. When you sell property for a profit, you typically have to pay capital gains tax. The same rule applies to crypto. If you buy a cryptocurrency and later sell it for a higher price, you have a taxable capital gain. It's also important to understand that this taxable event is not just triggered by selling for US dollars. Trading one cryptocurrency for another, for example, trading Bitcoin for Ethereum, is also considered a sale of the first asset and is a taxable event. Even using cryptocurrency to pay for goods or services is treated as a sale of the crypto, and you would need to account for any gain or loss. This makes record keeping extremely important for anyone transacting with digital assets. This complex web of agency oversight has led to calls for more regulatory clarity. Congress has been actively debating several pieces of legislation to create a more unified federal framework. For example, bills have been introduced to define the roles of the SEC and CFTC more clearly, and to create a specific regulatory regime for stablecoins, requiring them to hold reserves to ensure they can maintain their value. This legislative process is ongoing and shows that the rules for cryptocurrency are still being written. The landscape you see today may look very different in the years to come. To summarize, the US does not have a single, overarching law for cryptocurrency. Instead, multiple agencies regulate different parts of the ecosystem. The SEC looks at some assets as securities, the CFTC treats others as commodities, FinCEN enforces anti-money laundering rules, and the IRS treats all crypto as property for tax purposes. This creates a complex but developing system of oversight. Understanding these basic roles is a key part of navigating the crypto world responsibly. In our next chapter, we will address another critical topic: the risks and common scams that exist in the cryptocurrency space, and how to stay safe. Thank you for listening. Hello and welcome back. In our journey so far, we've explored the technology, the assets, and the rules of the cryptocurrency world. Now we must address one of the most important topics for anyone even remotely interested in this space: safety. The digital asset world is new and exciting, but like any frontier, it has its share of risks and bad actors. Our goal today is to provide an educational overview of the inherent risks and to raise awareness about the most common scams, so you can approach the space with caution and knowledge. As we begin, our disclaimer is more critical than ever. This chapter is for informational and educational purposes only. It is not financial, investment, or security advice. We are describing potential risks and common scams for awareness. Always be vigilant, conduct your own research, and understand that you are solely responsible for the security of your own assets. First, let's talk about a risk that isn't a scam, but a fundamental characteristic of the market: price volatility. As we've mentioned, the value of cryptocurrencies can change dramatically in very short periods. Prices can swing by large percentages in a single day. This volatility is due to several factors. The market is still relatively young, and not as large as traditional stock or bond markets. It's also a 24/7 global market, influenced by news, social media sentiment, and regulatory developments from all over the world. Understanding and being aware of this inherent volatility is a foundational aspect of learning about the crypto space. Beyond market risks, there are active threats from individuals and groups who seek to deceive people and steal their funds. Knowledge is the first and best line of defense against these threats. Let's cover some of the most common categories of scams. One of the most frequent types of scams is the impersonation scam. Scammers will pretend to be someone you trust. This could be a government agency, a well-known company, or even the support staff from a cryptocurrency exchange you use. They might contact you via email, text, or social media with an urgent message, perhaps claiming your account is compromised. Their goal is to trick you into giving them your password, private keys, or remote access to your computer. A key thing to remember is that legitimate companies and government agencies will almost never contact you unsolicited to ask for your passwords or secret recovery phrases. A popular and often effective version of this is the phishing scam. Scammers create fake websites or mobile apps that look nearly identical to the real ones. They might send you an email with a link that says log in to secure your account. If you click that link and enter your username and password on the fake site, you have just handed your credentials over to the scammer. Always be meticulous about checking website URLs. Bookmark the official sites you use and only access them through your bookmark, rather than clicking on links in unsolicited emails. Another very common category is the investment or get-rich-quick scam. These often appear on social media platforms like YouTube, X, formerly Twitter, or Telegram. You might see a post from what looks like a celebrity or a successful investor promising to multiply any crypto you send them. They might call it a giveaway or a special investment opportunity. These are always scams. Another version involves a scammer posing as an investment manager who contacts you directly, promising guaranteed high returns with no risk. Remember, in any legitimate financial market, there is no such thing as a guaranteed high return with no risk. Promises that sound too good to be true invariably are. A particularly cruel and increasingly common scam is the romance scam, sometimes called a pig butchering scam. A scammer will find a victim on a dating app or social media and spend weeks or even months building a sense of trust and a romantic relationship. Once that trust is established, they will begin to talk about a fantastic cryptocurrency investment opportunity they have. They will guide the victim to deposit money into a fake, sophisticated-looking trading platform. The platform will even show fake profits growing. The scammer will encourage the victim to invest more and more. When the victim finally tries to withdraw their money, they find that it's impossible, and the scammer disappears. Finally, be aware of malware. Scammers may try to trick you into downloading a file or a piece of software that contains malicious code. This could be a keylogger, which records everything you type, including your passwords, or a clipboard hijacker, which automatically replaces a crypto address you are trying to paste with the scammer's address. Be extremely cautious about downloading attachments or software from unverified sources. So, what are some general safety principles to keep in mind? First, guard your keys and phrases. Your private keys and your 12 or 24-word recovery phrase are the master keys to your funds. Treat them like your most valuable possession. Never share them with anyone for any reason. Never enter them into any website. Write them down on paper and store them in a secure, offline location. Second, be skeptical. Always question unsolicited messages, whether they are emails, texts, or direct messages on social media. Be wary of anyone creating a sense of urgency, pressuring you to act immediately. Scammers use the fear of missing out, or FOMO, to get you to lower your guard. Third, use strong, unique passwords and two-factor authentication, 2FA, for every account you create. Two-factor authentication adds a critical layer of security that makes it much harder for someone to access your account even if they manage to steal your password. This chapter is not meant to scare you, but to empower you with awareness. The cryptocurrency ecosystem, like the rest of the internet, requires a high degree of personal responsibility and vigilance. By understanding the risks and recognizing the common patterns of scams, you can navigate the space more safely. In our next chapter, we will look at the bigger picture and discuss the potential future of cryptocurrency and the role it might play in our evolving digital world. Thank you for listening. Hello and welcome back. Throughout this series, we have journeyed from the very basics of cryptocurrency to its real-world uses and the complex web of risks and regulations. In this chapter, we're going to look toward the horizon. What might the future hold for this technology? The world of crypto is famously fast-moving, and no one has a crystal ball. So our goal today is not to make predictions, but to explore the major trends, ongoing debates, and innovative ideas that are shaping what comes next. As we discuss these future-facing topics, our standard disclaimer is of the utmost importance. This chapter is for informational and educational purposes only. It is a discussion of potential technological trends and should not be considered financial or investment advice. The future is inherently uncertain, and the concepts discussed here are part of an ongoing, speculative, and experimental field. One of the most significant conversations happening at the highest levels of finance and government is about central bank digital currencies, or CBDCs. A CBDC is a digital form of a country's official currency. Unlike cryptocurrencies like Bitcoin, a CBDC would be centralized and issued and backed by a country's central bank, like the Federal Reserve in the United States. It would be the digital equivalent of a US dollar. Governments are exploring this idea for several reasons, including the potential for more efficient payment systems and a way to better implement monetary policy. The development of a US CBDC is still in a research and debate phase, but it represents a future where the technology inspired by cryptocurrency could be integrated directly into the traditional financial system. Another major trend shaping the future is the continued development of what many call Web 3. To understand Web 3, let's quickly recap. Web 1 was the early internet of the 1990s, static web pages that we could mostly just read. Web 2 is the internet we use today, a more interactive and social web dominated by large tech platforms that own and control user data. Web 3 is a vision for the next evolution of the internet, one built on the principles of blockchain, decentralization, user ownership, and verifiable trust. In a Web 3 world, users might have more control over their own data, digital identity, and assets through non-custodial wallets. This could lead to decentralized social media platforms where users, not corporations, control the content, or games where players truly own their in-game items as NFTs and can trade them freely. For this Web 3 vision to become a reality, blockchains need to be able to handle a massive number of users and transactions efficiently. This brings us to the crucial challenge of scalability. As we've discussed, some of the most secure blockchains, like Bitcoin and Ethereum, can be slow and expensive when they get congested. The industry is actively working on solutions to this problem, most notably through Layer 2 scaling solutions. Think of a Layer 2 as an express lane built on top of the main blockchain highway. It allows transactions to be bundled together and processed much faster and more cheaply off the main chain, with only the final results being recorded back to the secure base layer. These technologies are vital for making blockchain applications practical for mainstream, everyday use. Another powerful trend is the tokenization of real-world assets. Tokenization is the process of creating a digital representation, or token, of a real-world asset on a blockchain. This could be anything from a piece of real estate, a share of stock, a fine work of art, or a government bond. The potential benefit is that it could make traditionally illiquid assets more accessible and easily tradable. For example, instead of needing to buy an entire commercial building, investors could potentially buy digital tokens representing a small fraction of ownership. This could open up new markets and create more efficient and transparent ways to manage and transfer ownership of physical goods. We are also beginning to see a powerful convergence between two of the most talked about technologies of our time: artificial intelligence and blockchain. AI could help make blockchain systems smarter and more efficient, perhaps by analyzing on-chain data to detect fraud, or by automating complex smart contracts. Conversely, blockchain could help make AI more trustworthy. For example, a blockchain could provide a transparent and unchangeable record of the data an AI was trained on, making its decision-making process more auditable and secure. This is still a very new and experimental field, but it holds fascinating possibilities. Finally, the future of cryptocurrency will be heavily influenced by its continued institutional adoption. For years, crypto was seen as a niche for retail enthusiasts. Today, many of the largest financial institutions in the world are getting involved. They are exploring offering crypto services to their clients, investing in blockchain technology, and even using tokenization for their own operations. This influx of institutional interest provides a different kind of validation for the technology and is a major force driving the conversation around regulation and market maturity. Of course, the future is not without its challenges. The industry still faces significant hurdles, including the ongoing quest for clear and consistent regulation, concerns about the environmental impact of some blockchain networks, and the constant need to improve security and user experience to make the technology accessible to everyone. To conclude, the future of cryptocurrency and blockchain is not a single predetermined path. It is an active and dynamic landscape of competing ideas and innovations. From the governmental exploration of CBDCs to the user-centric vision of Web 3, and from the practical challenge of scalability to the futuristic intersection with AI, this technology continues to evolve at a breathtaking pace. The one thing that seems certain is that the core concepts of decentralization and digital ownership will continue to challenge and influence our digital world for years to come. In our next chapter, we'll begin to wrap up our series by discussing how to continue your learning journey and find reliable information in this complex space. Thank you for listening. Hello and welcome back. Over the course of this series, we have built a broad foundational understanding of the cryptocurrency world. We started with the simple question: what is cryptocurrency?
The information presented in this video is for informational and educational purposes only and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
And have since explored blockchain technology, major digital assets, regulation, and safety. But our journey together is just a starting point. This field is constantly changing, with new ideas and technologies emerging all the time. The most valuable skill you can develop is learning how to learn effectively and critically. So today, our goal is to equip you with a framework for continuing your educational journey safely and independently. As always, we must start with our guiding principle. This chapter is for informational and educational purposes only. We are not recommending any specific information source, influencer, or platform. We are not providing investment, financial, or legal advice. The aim is to help you develop the critical thinking skills necessary to evaluate information for yourself. The first step in learning about this space is to understand that the quality of information varies wildly. The internet is filled with everything from university-level research to outright scams and marketing hype. Your task is to learn how to tell the difference. A great way to do this is to build a balanced information diet by drawing from several different types of sources. Let's start with foundational sources. These are the primary documents and educational platforms that focus on explaining the how and why of a technology. For any specific cryptocurrency project you want to understand, the best place to begin is its white paper. As we mentioned in an earlier chapter, a white paper is the original document outlining the project's goals, the problem it aims to solve, and the technology it uses. While some can be highly technical, reading the introduction and conclusion can give you an unfiltered look at the project's original vision. Many major cryptocurrency projects also have extensive documentation on their official websites, written for developers and users. Additionally, many large, reputable exchanges and media outlets in the crypto space have dedicated educational sections on their websites, often called an academy or a learn page. These are often designed for beginners and can be excellent for understanding core concepts in a structured way. Next, let's consider news and analysis sources. There are several well-established digital media publications that focus exclusively on the cryptocurrency and blockchain industry. These can be valuable for staying up to date on market trends, new technological developments, and regulatory news. When consuming news, it's helpful to read from multiple sources to get a more balanced perspective. Be mindful of the tone of an article. Is it presenting facts, or is it trying to generate excitement and a fear of missing out? Often called FOMO, objective reporting focuses on the facts, quotes multiple sources, and acknowledges risks and unknowns. A third category is community and social sources. Platforms like X, formerly Twitter, Reddit, and Telegram are at the heart of the crypto conversation. Following developers, researchers, and project founders can provide real-time insights. However, this is also where you will encounter the most noise and hype. It is absolutely critical to approach social media with an extremely skeptical mindset. Never take a single post as fact. Be aware that many accounts are anonymous, and many influencers are paid to promote certain projects. Use social media to discover new ideas, but always verify those ideas through more reliable, foundational sources. Finally, there are official government and regulatory sources. If you want to understand the rules, go to the rule makers. U.S. agencies like the Securities and Exchange Commission, SEC, the Commodity Futures Trading Commission, CFTC, and the IRS all have sections on their official websites dedicated to digital assets. These resources provide factual, unbiased information about regulations, investor alerts, and tax guidance. For example, the SEC's investor.gov website is an excellent resource for learning about investor protection and how to spot fraud. As you navigate these sources, how do you develop a critical eye? Here are a few questions to ask yourself. First, who is the author and what is their motivation? Is the person writing this a developer, a journalist, a researcher, or an anonymous account with a vested interest in a project's price going up? Understanding the author's potential bias is key. Second, is this content educational or promotional? Educational content seeks to explain how something works, including its benefits and its limitations. Promotional content often uses urgent, overly positive language, promises high returns, and downplays risks. Be very wary of anything that sounds like a guaranteed success. Third, does the information make sense and is it verifiable? If a project makes grand claims about its technology, are those claims supported by its white paper or by analysis from independent researchers? If an article cites data, does it link to the original source of that data? Always try to trace information back to its primary source. To conclude, becoming knowledgeable about cryptocurrency is not about finding one secret source of perfect information. It's about building a process for continuous learning. It involves seeking out foundational, unbiased educational materials to build your core knowledge. It means consuming news from multiple reputable sources to stay current. And it requires treating social media as a place for discovery, not as a source of verified truth. By learning to think critically and question the motivation behind the information you see, you empower yourself to navigate this fascinating and complex space with confidence and caution. In our next chapter, we'll discuss the important topic of how cryptocurrency interacts with the traditional world, specifically focusing on its role in your personal finances and the broader economy. Thank you for listening. Hello and welcome back to our series. We've spent a lot of time in the digital realm, exploring the technology and culture of cryptocurrency. Today, we're going to bridge that world with the one we all operate in every day: the broader economy and the principles of personal finance. How does this new technology fit into the traditional economic landscape? And what are the established financial concepts people consider when thinking about this new asset class? Our goal is to explore these questions from a high-level, educational perspective. This chapter requires our most serious disclaimer yet. We are absolutely not providing financial, personal finance, or investment advice. The information here is for educational context only. Discussing financial principles is not a recommendation to act on them. Every individual's financial situation is unique, and decisions about money should only be made after careful personal consideration and consultation with qualified, licensed financial professionals. First, let's look at cryptocurrency's growing role in the U.S. economy. For a long time, digital assets were seen as a separate, niche market. However, the lines are beginning to blur. We are seeing two major trends: the integration of crypto into traditional financial services, and the adoption of blockchain technology by various industries. Major financial institutions are no longer just watching from the sidelines. Many are actively building infrastructure to support digital assets, from offering custody services for large clients to exploring the tokenization of real-world assets like bonds and real estate. The introduction of regulated financial products, such as exchange-traded funds or ETFs, that provide exposure to cryptocurrencies, has also created a more familiar bridge for traditional investors to interact with the asset class. Furthermore, the use of stablecoins for settling large transactions is being tested as a way to make the behind-the-scenes plumbing of the financial system faster and more efficient. Beyond Wall Street, the underlying blockchain technology is being adopted by companies to solve real-world business problems. We see this in supply chain management, where a blockchain can create a transparent and unchangeable record of a product's journey from the farm to the store shelf. In healthcare, it's being explored as a way to securely manage patient data. This slow but steady integration of the technology into the corporate world adds a layer of economic activity and utility that is separate from the price fluctuations of cryptocurrencies themselves. Now let's shift from the macroeconomy to the principles of personal finance. How do individuals even begin to think about where this new asset class fits? To understand this, we need to touch on two foundational concepts from traditional finance: asset allocation and diversification. Asset allocation is the strategy of dividing an investment portfolio among different asset categories, such as stocks, bonds, and real estate. The idea is that each asset class has a different risk and return profile. For example, historically, stocks have offered higher potential returns, but also come with higher risk and volatility. Bonds, on the other hand, have typically offered lower returns but with more stability. The goal of asset allocation is to balance risk and reward by choosing a mix that aligns with an individual's goals, timeline, and tolerance for risk. Diversification is a related concept, but it's about spreading your investments within an asset class. If you only own stock in one single company, your financial outcome is tied entirely to the fate of that one company. By diversifying and owning stocks in many different companies across various industries, you spread out that risk. The core principle is often summarized in the old saying, "Don't put all your eggs in one basket." So where does cryptocurrency fit into this framework? This is a topic of intense debate. Proponents argue that cryptocurrencies, particularly one like Bitcoin with a fixed supply and a global reach, represent a new, distinct asset class. They point to data that has sometimes shown its price movements are not closely correlated with the stock or bond markets. In theory, an asset with low correlation can be a powerful tool for diversification, because it may perform differently than the rest of a portfolio during certain market conditions. People who hold this view might consider allocating a small portion of a well-diversified portfolio to this asset class. On the other hand, critics and skeptics raise several important counterarguments. They argue that cryptocurrency is an extremely volatile and speculative asset with no long history of returns to analyze. Unlike a stock, which represents ownership in a company that produces goods and generates revenue, or a bond, which is essentially a loan that pays interest, many cryptocurrencies have no intrinsic value or cash flow. Their price is often driven by market sentiment and speculation. Furthermore, the regulatory landscape is still uncertain, which adds another layer of risk. Those who hold this view might see cryptocurrency as too risky for a traditional investment portfolio, treating it more like a speculative gamble than a structured investment. It's important to understand that both of these viewpoints exist and are debated by very smart people. There is no universal consensus on the role, if any, that cryptocurrency should play in a personal financial strategy. To conclude, the relationship between cryptocurrency and the wider economy is deepening, with traditional finance and various industries increasingly integrating the technology. When viewed through the lens of personal finance, the discussion revolves around established principles like asset allocation and diversification. Whether digital assets should be considered a legitimate component of these strategies is one of the most significant ongoing debates in the financial world. Understanding the different sides of this debate is a key part of developing a complete and nuanced view of the crypto ecosystem. In our next chapter, we will discuss the social and ethical considerations surrounding cryptocurrency, including topics like environmental impact and financial inclusion. Thank you for listening. Hello and welcome back. In our journey through the world of cryptocurrency, we've focused heavily on the technology, the markets, and the rules. But like any powerful new technology, crypto isn't just about code and finance, it's about people. Today, we're going to step back and explore some of the important social and ethical questions that surround this space. These are complex debates with passionate arguments on all sides, and our goal is not to find the right answer, but to understand the different perspectives. As we navigate these sensitive topics, please remember that this chapter, like our entire series, is for informational and educational purposes only. We are presenting a neutral overview of ongoing societal debates, not endorsing any particular viewpoint or offering any kind of advice. Perhaps the most prominent ethical debate revolves around cryptocurrency's environmental impact. This conversation is centered on the consensus mechanism we've discussed before, known as proof of work. Blockchains like Bitcoin use proof of work, which relies on a global network of powerful computers, or miners, racing to solve complex mathematical puzzles. This process is what secures the network, but it consumes a tremendous amount of electricity. Critics argue that this energy consumption, much of which comes from fossil fuels, contributes to carbon emissions and environmental strain. They point to estimates suggesting that the Bitcoin network's annual energy usage can be comparable to that of entire countries. In response to this concern, the crypto community has put forward several arguments and solutions. One perspective is that the energy is well spent, securing a global, decentralized financial network that offers unique value. Some also argue that a growing percentage of Bitcoin mining is powered by renewable energy sources, or that it utilizes stranded energy that would otherwise go to waste. The most significant technological response, however, has been the development of an alternative consensus mechanism called proof of stake. As we've mentioned, networks like Ethereum have transitioned to proof of stake, which does not rely on energy-intensive mining. Instead, it uses a system where users lock up, or stake, their own crypto to help secure the network. Studies have shown this method can reduce a blockchain's energy consumption by over 99%, effectively resolving the energy debate for those specific networks. Another major social topic is financial inclusion. Proponents of cryptocurrency often highlight its potential to help the unbanked and underbanked, billions of people around the world who lack access to traditional banking services. For someone without a bank account, sending or receiving money, especially across borders, can be slow and prohibitively expensive. Because cryptocurrency operates on a global, permissionless network, anyone with a basic smartphone and internet access can, in theory, download a wallet, receive funds, and become their own bank. This could be transformative for people who are excluded from the traditional financial system. dramatically lowering the cost of remittances and providing access to savings and credit through DeFi applications. However, there are significant counterarguments and practical challenges to this vision. Critics point out that the people who are most likely to be unbanked may also lack consistent internet access or the digital literacy needed to navigate the complexities of cryptocurrency safely. The high volatility of many cryptocurrencies also presents a major risk for individuals with limited means, as the value of their savings could decrease dramatically overnight. While stablecoins can address the volatility issue, the barriers of technology, education, and security remain significant hurdles to achieving true financial inclusion on a mass scale. Finally, there is the persistent question of cryptocurrency's use in illicit activities. Because crypto can be sent peer-to-peer with a degree of pseudonymity, it has been used by bad actors for activities like money laundering, ransomware attacks, and terrorist financing. This has led some to view the entire space with suspicion, seeing it as a tool primarily for those who wish to operate outside the law. While these illicit uses are a serious and undeniable problem, the full picture is more nuanced. Many in the crypto and law enforcement communities argue that the transparency of most blockchains can actually be a powerful tool for fighting crime. Unlike cash, which is untraceable, every transaction on a public blockchain like Bitcoin's is recorded on an immutable public ledger. Specialized blockchain analysis firms work with agencies like the FBI to trace the flow of illicit funds, de-anonymize criminals, and recover stolen assets. While privacy-focused cryptocurrencies do exist and present a greater challenge, the notion that all crypto is completely anonymous and untraceable is a common misconception. The debate continues over how to balance the right to financial privacy with the need to prevent crime. To conclude, the social and ethical landscape of cryptocurrency is not black and white. It is a series of complex trade-offs. The environmental cost of proof of work is weighed against the security it provides, and the rise of more sustainable alternatives. The incredible potential for financial inclusion is balanced by the real-world barriers of access, education, and volatility. And the challenge of preventing illicit use is countered by the surprising transparency of the blockchain itself. Understanding these debates is essential for a well-rounded view of cryptocurrency's role in the world, not just as a technology, but as a human endeavor with real-world consequences. In our next chapter, we will begin to synthesize everything we've learned by building a simple, step-by-step mental framework for analyzing and understanding any cryptocurrency project you might encounter. Thank you for listening. Hello and welcome back. Throughout this series, we've explored the vast and varied landscape of cryptocurrency. We've seen that there are thousands of different projects, each with its own technology, goals, and community. A common question that arises is, with so many projects out there, how can I even begin to understand what makes them different? Today, we are going to address that question directly. Our goal is to build a simple educational framework, a set of questions you can ask, to help you analyze and understand any crypto project you encounter. This is a framework for learning and critical thinking, not for investing. Therefore, our standard disclaimer is critically important. This chapter is for informational and educational purposes only, and is not financial or investment advice. We are providing a mental model to help you organize your research and deepen your understanding. Any financial decisions should be made only after your own thorough research and consultation with a qualified financial professional. Think of this framework as having 4 key pillars. For any project you want to understand, you can explore its purpose, its people, its technology, and its tokenomics. Pillar 1, the purpose. What problem does it solve? The first and most fundamental question to ask about any project is, why does this exist? A project with long-term potential usually has a clear and understandable purpose. It should be trying to solve a specific problem or improve upon an existing system. Is it aiming to be a faster and cheaper payment network? Is it a platform for decentralized applications? Is it designed to protect user privacy? To explore this, you can ask yourself a few simple questions. In 1 or 2 sentences, can I explain what this project does? If you can't, it might be a sign that the project's vision isn't clear. Who is the intended user? Is it for individuals, for businesses, for developers? What is the project's value proposition? Does it offer a solution that is significantly better, faster, cheaper, or more secure than the alternatives, whether those alternatives are on the blockchain or in the traditional world? A project that can't clearly articulate the problem it is solving may lack focus and a real-world reason to exist beyond speculation. Pillar 2, the people. Who is building it? Ideas are important, but execution is everything. Behind every crypto project is a team of people responsible for building the technology, managing the community, and navigating the future. Understanding who these people are can provide insight into the project's potential for success. When looking at the team, consider these questions. Is the team public and transparent? Can you easily find the names and backgrounds of the core developers and leaders? While some successful projects have been founded by anonymous figures, a public and accountable team often provides a greater degree of confidence. What is the team's experience? Do they have a track record in software development, cryptography, business, or the specific industry they are trying to innovate in? How does the team communicate with its community? Do they provide regular updates on their progress, acknowledge challenges, and engage with user feedback? A healthy, transparent relationship with the community is often a positive sign. Pillar 3. The technology. How does it work? You don't need to be a computer scientist to get a basic grasp of a project's technology. Your goal is to understand the project's overall design and its progress. The project's white paper is often the best place to start, but if it's too technical, look for summaries or documentation on the project's official website. Key questions to ask about the technology include: is the technology actually working? Does the project have a functioning product? Or is it still just an idea on a white paper? You can often check this by looking for a mainnet launch, which indicates the blockchain is live. What is the project's roadmap? A roadmap is a document that outlines the team's plans for future development and milestones. Does the team have a clear vision for the future? And have they historically met their stated goals? Is the project's code open source? Most legitimate cryptocurrency projects make their code publicly available for anyone to inspect. This allows for independent security audits and demonstrates a commitment to transparency. Pillar 4. The tokenomics. What are the rules of the token? Tokenomics is a blend of the words token and economics. It refers to the economic design of a cryptocurrency, the rules that govern its supply, distribution, and utility. This is a crucial area to understand. Here are some fundamental questions to explore. Utility. What is the token actually used for within the project's ecosystem? Does it function as a currency for payments? Is it used to pay for transaction fees? Does it give holders the right to vote on the project's future, a concept known as governance? A token with a clear and necessary use case has intrinsic demand. Supply. How many tokens will ever exist? Is there a fixed maximum supply, like Bitcoin's 21 million, which makes it scarce by design? Or is it an inflationary token with an unlimited supply? Understanding the supply schedule is key. Distribution. How were the tokens first created and distributed? Were they fairly distributed to a wide community? Or was a large percentage given to the founders and early investors? A highly concentrated ownership can pose risks, as a small number of holders could have a significant influence on the price. By asking questions across these 4 pillars, purpose, people, technology, and tokenomics, you can build a structured and comprehensive understanding of any cryptocurrency project. This analytical approach encourages you to look past the hype and focus on the fundamentals. It moves you from being a passive observer to an active and critical learner. In our next chapter, we will discuss the practical steps of getting involved in the crypto community, beyond just acquiring assets, by exploring how to participate in governance and contribute to projects. Thank you for listening. Hello and welcome back. In our journey so far, we have often talked about cryptocurrency in the context of acquiring and holding digital assets. But the heart and soul of the crypto world, especially in decentralized projects, is the community. These are not just passive products. They are living ecosystems of developers, users, and enthusiasts from all over the globe. Today we're going to explore what it means to be an active participant in this world, moving beyond the role of a passive holder to become part of a project's community in a meaningful way. As we discuss these methods of participation, please remember our consistent and crucial disclaimer. This chapter is for informational and educational purposes only. It is not financial advice, nor is it a recommendation to join or contribute to any specific project. The goal is to make you aware of the different avenues for engagement that exist within the crypto space. One of the most revolutionary ideas in cryptocurrency is decentralized governance. In a traditional company, major decisions are made by a CEO and a board of directors. Many decentralized crypto projects aim to turn this model on its head. They are designed to be run by their communities, allowing the users and stakeholders to have a direct say in the future of the project. This is often accomplished through a structure called a decentralized autonomous organization, or a DAO. A DAO is essentially an online community with a shared bank account and a transparent set of rules. Decisions are not made behind closed doors. Instead, a member of the community can create a formal proposal. For example, a proposal to fund a new feature, change a fee structure, or donate to a charitable cause. These proposals are then voted on by the other members of the community. How does this voting work? It's often tied to the project's native cryptocurrency, specifically through what's known as a governance token. In many of these systems, holding the project's governance token grants you voting rights. The more tokens you hold, the more weight your vote carries. This model, often called on-chain governance, ensures that the people with a vested interest in the project's success are the ones making the critical decisions. You can often see these proposals and vote on them through a project's official website. Simply observing this process can be a powerful way to learn what a community values and how it operates. But what if you want to contribute in a more hands-on way, perhaps without even owning the token? The good news is that most crypto projects, being open source by nature, welcome contributions from anyone, anywhere in the world. Your skills, not just your capital, are valuable. If you are a software developer, the path is clear. You can review the project's open source code on platforms like GitHub, fix bugs, suggest improvements, and submit your own code. Many projects offer grants or bounties for developers who help strengthen their technology. But you absolutely do not need to be a coder to make a significant contribution. Are you a good writer or educator? Most projects are in desperate need of clear, easy-to-understand documentation, tutorials, and articles explaining how their technology works. Helping to improve a project's educational materials is an incredibly valuable service. Do you have a knack for design or user experience? You can provide feedback on a project's website or application, suggesting ways to make it more intuitive and user-friendly for newcomers. Are you fluent in another language? Helping to translate a project's website and documentation can make it accessible to an entirely new global community. Do you enjoy helping others? You can become a valuable member of a project's community on platforms like Discord or Telegram. By welcoming new members, answering their questions accurately, and directing them to helpful resources, you can help foster a healthy and supportive environment. Another important way to participate is by becoming a tester. Before a major new feature or an entirely new blockchain is launched, it first goes through a testnet phase. A testnet is a simulated version of the blockchain where new code can be tried out without risking any real funds. Projects often encourage users to experiment on the testnet, try to break things, and report any bugs they find. Participating in a testnet is a fantastic way to get an early look at new technology and play a direct role in making it more secure and reliable before it goes live. To conclude, being a part of the cryptocurrency world can mean much more than just buying an asset. The ethos of this space is rooted in collaboration and community ownership. By understanding how decentralized governance works, you can become an informed observer of how these new digital organizations function. And by recognizing the value of your own unique skills, whether they are in writing, design, community management, or testing, you can find ways to contribute directly to the projects that you find interesting and important. This shift from passive holder to active participant is where the true potential of a decentralized community comes to life. In our final chapter, we will bring everything together, summarizing the core principles we've learned and offering some closing thoughts on approaching this space with a balanced and responsible mindset. Thank you for listening. Hello, and welcome back for the final chapter of our series. We began this journey with a simple question. What is cryptocurrency? Over 14 chapters, we have traveled from the basic concepts of digital money and blockchain to the vast ecosystem of altcoins, the challenges of regulation, the importance of security, and the social questions that this technology raises. Our goal was never to give you answers, but to provide you with the foundational knowledge and the critical thinking tools to ask the right questions for yourself. In this concluding chapter, we will bring everything together, summarizing the core principles we've learned and offering some final thoughts on how to approach this space with a balanced, responsible, and curious mindset. As we conclude, it is essential to present our disclaimer one last time. This entire series has been for informational and educational purposes only. It is not and has never been financial, investment, legal, tax, or any other form of professional advice. The world of digital assets is complex, volatile, and carries significant risks. Your journey from this point forward must be guided by your own independent research and, when appropriate, consultation with qualified professionals. Let's begin by recapping the most fundamental ideas we've covered. At its core, cryptocurrency represents a paradigm shift in how we think about value and trust. The invention of the blockchain gave us a way to create a secure, transparent, and unchangeable public ledger without needing a central authority like a bank or government to manage it. This concept of decentralization is the bedrock of the entire crypto world. We learned that Bitcoin was the original proof of concept, designed as a peer-to-peer electronic cash system with a provably scarce supply. This inspired a universe of altcoins, like Ethereum, which expanded the vision of what a blockchain could do by introducing smart contracts and creating a global, decentralized computer for building new kinds of applications. We've also seen that this technology is not without its trade-offs. The debate over the environmental impact of proof of work, the ongoing quest for scalability, and the critical need for robust security are all challenges that the community is actively working to solve. The regulatory landscape in the United States is a complex patchwork, and the rules are still being written, which adds a layer of uncertainty. So with all this information, what is the path forward? Your path forward is one of continuous learning. This series was designed to give you a map and a compass, but you must walk the trail yourself. The analytical framework we discussed in Chapter 13, evaluating a project's purpose, people, technology, and tokenomics, is your tool for this journey. When you encounter a new project or a new idea, don't just ask if its price might go up. Ask, what problem does this solve? Who is building it? Does the technology work? And what are the rules of the system? As you continue to learn, it is vital to cultivate a mindset of healthy skepticism. The cryptocurrency space is filled with brilliant innovators and passionate communities, but it is also filled with hype, marketing, and bad actors. Learn to recognize the difference between educational content and promotional material. Be wary of promises that sound too good to be true. As we discussed, any claim of guaranteed high returns with no risk is a major red flag. Ground your understanding in foundational knowledge, not in social media excitement or the fear of missing out. It is also crucial to maintain a balanced perspective. It is possible to believe that this technology has revolutionary potential, while also acknowledging that it is still experimental and faces enormous hurdles. You do not have to be a maximalist who thinks crypto will solve every problem, nor a dismissive skeptic who believes it has no value. The most insightful perspective is often found in the nuanced middle ground, recognizing both the promise and the peril. The future of this technology is not guaranteed. It will be shaped by the developers who build it, the regulators who oversee it, and the communities that use it. Finally, remember the principle of personal responsibility. In a decentralized world, you are in control. This is empowering, but it comes with the profound responsibility of securing your own assets. The phrase, "not your keys, not your coins," is one of the most important lessons in this space. Understanding how wallets work and how to protect your private keys and recovery phrases is not an optional step. It is an absolute necessity. Our series is now at its end, but your education is just beginning. We hope that we have demystified the jargon, clarified the core concepts, and armed you with a framework to continue learning with confidence and caution. The digital age is evolving rapidly, and the principles of decentralization, digital ownership, and verifiable trust are likely to play an important role in our collective future. By approaching this topic with curiosity, skepticism, and a commitment to continuous learning, you are well equipped to understand the ongoing conversation and your place within it. Thank you for listening.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research, and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.